Welcome to today's discussion on the future of real estate. Will we see a housing market collapse? The housing market is something that affects almost everyone, whether you're a homeowner, an investor, or just someone trying to find affordable housing. Over the last few years, housing prices have skyrocketed in many areas, leading many to wonder, are we in the midst of a housing bubble, and if so, when will it burst? Will we see another housing market collapse like the one that devastated the global economy in 2008? Or are we on a path to something different? In this guide, we'll dive deep into the current state of the housing market, explore the factors that could influence its future, and address whether a collapse is imminent or just a myth. Let's get started. Chapter 1. A look at the current housing market. Before we talk about the future, it's important to understand the present. So, what's going on in the housing market today? For the past few years, we've seen unprecedented home price growth. In fact, home prices in many areas have hit all-time highs, and inventory levels are at historically low levels. This is partly due to factors like low mortgage rates. When the pandemic hit, central banks around the world slashed interest rates to historic lows. Mortgage rates followed suit, making it cheaper for buyers to borrow money. This led to an influx of demand in the housing market. Limited housing supply. Builders have struggled to keep up with demand, partly because of supply chain issues and labor shortages. The shortage of new homes has compounded the issue, driving up prices for existing homes. Remote work and migration trends. The pandemic also accelerated a shift toward remote work, allowing people to move out of crowded cities to suburban or rural areas. This has created new pockets of demand in places that historically didn't see much growth. Investor activity. Real estate investors, including large institutional buyers, have also been snapping up homes, driving up prices even further. These investors often pay in cash, which gives them an edge in competitive markets. But as we all know, rapid price growth can't continue forever. The question is, will this current market slow down and eventually lead to a collapse, or will it cool down gradually? Chapter 2. What caused the 2008 housing market collapse? To answer whether we might face a housing market collapse in the future, it's helpful to look at what happened in 2008. The 2008 housing market collapse, also known as the Global Financial Crisis (GFC), was one of the worst economic downturns in history. So what caused it? The primary reasons for the collapse were subprime lending. Lenders were giving loans to people who couldn't afford them. These were called subprime loans, high-risk loans offered to borrowers with poor credit histories. Many of these loans had adjustable rates, meaning payments would start low but increase significantly after a few years. This led to a massive number of defaults when homeowners couldn't afford their payments. Housing speculation. There was rampant speculation in the housing market. Investors and homebuyers were betting that housing prices would continue to rise indefinitely. This led to an unsustainable price bubble. When prices started to drop, the bubble burst and the market collapsed. Financial products and derivatives. Banks created complex financial products that were based on these risky loans. These included mortgage-backed securities, MBS, and collateralized debt obligations, CDOs. When homeowners defaulted on their loans, these securities lost their value, causing banks to lose billions of dollars. Lack of regulation. There was little oversight or regulation of these risky lending practices. The financial system was operating under a false sense of security, and when the bubble burst, the effects rippled throughout the global economy. The aftermath was devastating. Millions of people lost their homes, banks went under, and the global economy entered a deep recession. Chapter 3. Is a housing market collapse possible again? Now fast forward to today. Many people are asking if we're heading toward another housing market collapse. Is it possible? Let's take a look at some of the factors that could contribute to a housing market downturn, and whether they exist today. Rising interest rates. One of the key differences between the current market and the 2008 crash is the interest rate environment. In 2022 and 2023, we saw the Federal Reserve raise interest rates to combat inflation. Higher rates mean higher mortgage payments, which could reduce buyer demand. As borrowing costs rise, some buyers may be priced out of the market, leading to lower home prices. Inflation and economic slowdown. Inflation is at a multi-decade high, which erodes purchasing power. If wages don't keep pace with rising costs, people may struggle to afford homes. In addition, if the economy slows down or enters a recession, housing demand could drop, contributing to price corrections. Oversupply of homes. While we've seen low housing supply in recent years, things may be changing. New home construction is starting to pick up, and inventory is beginning to rise in some areas. If supply exceeds demand, prices could fall, leading to a market correction. Weakened buyer confidence. If economic conditions worsen, consumer confidence could drop, causing buyers to hold off on purchasing homes. The more people hesitate to buy, the greater the potential for price declines. But even though these factors could cause a slowdown, it's important to note that we're not seeing the same conditions that led to the 2008 collapse. Here's why. Chapter 4. Key differences from the 2008 collapse. While there are some similarities, there are also key differences between today's housing market and the 2008 crash. Let's explore these differences. Stronger lending standards. Since 2008, lenders have significantly tightened their standards. It's much harder to get a mortgage if you don't have a solid credit score or reliable income. Today's buyers are generally more qualified than those leading up to the 2008 crash. Equity in homes. Many homeowners today have more equity in their homes than they did in 2008. This means they're less likely to default on their loans as they're not underwater, owing more than the house is worth. In contrast, many homeowners before 2008 had little to no equity, which made them more susceptible to foreclosure. Stronger economic recovery post-pandemic. After the initial shocks of the pandemic, the economy has rebounded. Unemployment rates are low and consumer spending is strong. While inflation and interest rates are concerns, the overall economic outlook is more stable than it was before the 2008 collapse. Government intervention. In the wake of the 2008 crash, governments around the world introduced a range of regulatory measures to prevent another financial meltdown. This includes stricter rules for banks, improved transparency in financial products, and better consumer protection laws. These measures make a repeat of the 2008 crisis less likely. Chapter 5. What could the future hold for the housing market? So, what does the future of real estate look like? Will we see a collapse or just a cooling off of the market? Here are a few possibilities. Price correction, not a collapse. It's likely that the housing market will experience a correction, a slowdown in price growth or a modest decline in some areas. However, a full collapse like in 2008 seems unlikely given the current conditions. Instead, we might see a cooling period where buyers and sellers find more balance. Affordability challenges. One of the biggest concerns for the future is housing affordability. With high prices and rising mortgage rates, many potential buyers may struggle to afford homes, especially first-time buyers. This could lead to stagnation in some markets, with homes sitting on the market longer and price growth slowing. Increased demand for rentals. If homeownership becomes out of reach for more people, the demand for rental properties could increase. This could drive up rent prices and create opportunities for real estate investors in the rental market. Regional variability. The housing market is not uniform across the country. While some areas may experience price declines, others, especially those with strong job growth and desirable locations, could continue to see high demand. If you're looking to buy, it's important to consider regional trends. So, will we see a housing market collapse? The short answer is, probably not in the same way we did in 2008. While a price correction is possible due to factors like rising interest rates, inflation, and shifting buyer demand, the housing market today is fundamentally different from what led to the previous crash. For homeowners, investors, and potential buyers, the best strategy is to stay informed and be prepared for market changes. Understanding the forces that drive the market, diversifying your investments, and maintaining financial flexibility will help you navigate whatever the future holds. Thanks for listening to this deep dive into the future of real estate. If you found this discussion helpful, don't forget to like, share, and subscribe for more insights on housing, real estate, and financial trends. Stay informed, stay proactive, and remember, the market may go up and down, but with the right approach, you can always find a way to thrive.